So tonight I'm going to talk about Chapter 15, which is how to raise capital. And mostly it's about, in general, the first half is about, how does an IPO work? And then the second half is about, most of the meat of the chapter, math-wise, is in the rights, what a rights offering is. So that's where most of the math and the difficulty is. But in terms of the different types of capital, when you want to start a company, or you've already started a company and you want to expand. It's not in the textbook, but there's one that's not there, which it's not a textbook, but I'll just tell you about it. It's called angel investors. It's kind of like venture capitalists, but on a smaller scale. So when you talk about Dragon's Den, this is kind of halfway between an angel investor and what a venture capitalist would be. Venture capital is when you want to, because if you just are starting and you're what are called pre-revenue, right? You're not actually selling something yet. You're in the middle of developing a product. You go see a bank. What they're going to tell you is you're not bankable. Banks only loan based on past results. So if you have no results, don't waste your time going to a bank, even if you have tons of security. For example, in my case, I'm buying a building that's $450,000, and the bank would only give me a mortgage for $200,000, meaning that even if something goes bad and I don't pay back my thing, obviously, if a building sold for $450,000, they should be able to sell it for $200,000, get their money back. But banks are extremely nervous. They barely loan to anybody at all, unless you've been in business for many years, and then they loan to you based on what your past results are. So when you're trying to start up something new, you're in the middle of developing a product. You're in an R&D phase. Generally, like I said, what you call pre-revenue. You haven't sold any. Maybe you're in the middle of developing a prototype. Maybe you have a prototype. You're just now bringing it to market. That's a time when venture capital can invest in your business. Venture capital is not only about the capital, the money itself, but what they do is typically venture capital companies are entrepreneurs that have been successful themselves. So typically you have, anywhere from 5 to 12 partners in a venture capital firm or a venture capital fund. And so what they do is, in addition to giving you the money for you to maybe buy equipment or spend on marketing, they also have a very hands-on approach. So they'll help you. You usually will have very seasoned entrepreneurs to help you along. Maybe somebody that if you're in the internet area, then somebody that has founded a company, or somebody that has grown a company, somebody that has a lot of experience in that industry. And they bring, obviously, because they put their money in, they want to see it work, and so they're going to do everything they can to help you get there. Venture capitalists, their strategy is to take a big chunk of your company. In general, if you can self-fund a company, if you can come up with your own money or the money of family and relatives, what we generally call love money, you're a lot better off, because when you go see a venture capital, first thing, you're probably going to lose control of your company. It's very rare that a venture capitalist will give you money without having voting control. Typically, what we call it a venture capital deal is the number is 51-50. They take 51% at least of the company so that they can control what's going on. Because obviously, if they put 2, 3, 4, 5 million in, they don't want you to just toss it down the drain and then lose all their money. So and the other number, 50%, is the type of return that they're looking for in terms of their investment. So that's a pretty high cost of equity. You're talking 50%. Just in comparison, for example, credit cards are around 18, 20, 22, 25. You can have, obviously banks are at the very banks are the zero risk, zero reward, more or less, like very low risk, very low reward part of the investment curve, and the venture capitalists are on the other end. The kind of way that a venture capital company makes money or fund is that they figure that they basically just take a bunch of what you would call flyers, a bunch of chances. And they, out of 10 investment, probably 7 or 8 of them will go to zero. 1 or 2 of them will be, mild successes, maybe break even. And then you got the odd one that's like a 10 times, 20 times your investment. So that's the business model of a venture capital fund. It's to invest in many different things in the hope that one of them just really goes. The last point, some large corporations have a venture capital division. There's very different types of venture capital funds. Some of them are government sponsored. Maybe they're trying to create employment in a certain region. So some of them are geographic in nature. Some VC funds are industry specific in nature. So it could be just medical or just IT or so on. But also big companies, sometimes what they do is they use, for them it's a way to do R&D. It's a way to kind of externalize or outsource their R&D process. By instead of having a big large corporate R&D department, what they do is they take the money that they would have put in there and then they invest it in a whole bunch of startup, knowing that if one of them goes well, then they then buy it and bring it into their main operations. But in general, the way out for VC is there's 2 things. Either 1, an IPO, or 2, a sale to what you would call a strategic buyer. So it could be, say you have a venture capitalist in maybe the drug industry, then their goal is to sell it to like Merck or Pfizer or something like that. How do you look at venture capitalists? Financial strength. Obviously, when you're building a company, usually you don't get all the money in the first. You have what are called rounds. So maybe you'll have 2 rounds or 3 rounds. So you want to make sure that you're with a VC fund that's big enough that after they make that investment, if in 2 or 3 years you need to double maybe you're going after Canada or the US, and then all of a sudden you want to go after Europe and Asia, then you want to make sure that this is a company that could help you also with the second round. It's a lot easier than start back from scratch to find somebody else. Style, there's very different styles. There's some people that are in your face, they just control everything. They'll put somebody not just on your board but on your management team that's at your office every day. Some others, they're more hands-off, but when you invest a lot of money, you want to make sure that it's not wasted. So VCs tend to keep quite a close eye on what's going on. Contacts. Obviously, if you're talking especially about industry-specific type of venture capital funds, if you have a person that's founded a company and built it up for over 5-10 years, that person will have accumulated a huge network of connections in that industry. And like I said, when you go to a VC, it's not, it is about the money, but it's also about what are the other things that they bring to you. And that could be a big one. Say you're selling into, like going back to the medical stuff. Say you're selling into the hospital market. You're selling some kind of heart, device or something like that. Well, it would help to have somebody that already knows all the different people you can go to sell your thing. So that's the kinds of things that a venture capitalist brings. And exit strategy, well, most VCs are, even now, like in the past, they were looking at longer horizons, but nowadays they tend, whereas before it might have been a 7, 8, 10 year investment horizon, now they would look for something to happen within 3 or 5 years or sometimes even less. Next, the public issue or IPO, initial public offering. This is when the first time that you sell your shares to the public. And in Ontario, you have the Ontario Securities Commission. So, meaning that I think it's if you have once you have more than 50 shareholders, private shareholders, you have to go public. There's a limit on the number of different shareholders you can have before you're actually forced to go public. And TSC is the Toronto Stock Exchange. But one thing that's very interesting about Canada in terms of the public markets is the TSC has this kind of two-tier system. It's kind of like, to use a sport analogy, they got the NHL, and then they got the American League, the kind of farm league, which is called the Toronto Venture Exchange. And you can go public on that with a much earlier in the history of your company. I think the requirements are quite low. I think it's something on the order of $500,000 in revenue, if $100,000 in net working capital, and that's, you don't need to be like a multi-million-dollar company before you're able to go public. So that's one advantage, I guess, of the capital markets in Canada. That has to do with the Toronto Stock Exchange. Is really it's not really the Toronto Stock Exchange anymore, because it merged with the Vancouver Exchange and the Montreal Exchange. Montreal Exchange is about derivatives, and the Vancouver Exchange was about the smaller companies like junior miners, junior oil and gas companies. And so that what used to be the kind of Vancouver Stock Exchange became this Toronto Venture Exchange. But it's not limited to just natural resources. There's lots of other companies that go public on that. It's going public. Everybody thinks in the dot-com days it was like, oh, go public, make a whole bunch of money. It's people are resisting it quite a bit now, because it is an amazing amount of overhead and extra expense that it adds to your company. And in terms of, it forces you to think a lot more short term. The problem with being public is you got to publish your financial statements every 3 months. And so a lot of times, if you got the choices in terms of strategy of a quick payoff, or doing something really smart where you're going to make a lot of money in 3 years, 4 years, 5 years, the market tends to really punish long-term thinking when it comes to companies, and that's a real shame. And that's a reason why so many companies now stay public for a lot longer, and sometimes even once they're public, they go back private because they can't take all the overhead. Like you got like the cost of going public, even for that small company I was talking about, like the TSX Venture Exchange, you're talking about hundreds of thousands of dollars in legal fees and writing a prospectus. Before, you might have had just what are called just compiled or review engagements, the financial statements. Now you got to have audited statements. That's another $20,000-$25,000 a year minimum to get financial statements audited. So it adds quite a bit of cost. It adds quite a bit of overhead, and it sucks quite a bit of management time when they could be, running the business, working with their employees to make things better. You have to talk to financial analysts. You have to, meet with lawyers, meet with accountants, and meet with investment bankers. It can be, people think that, doing an IPO is like the greatest thing in the world. It's not really. Like, there's quite a bit of cost and quite a bit of time and quite a bit of effort in doing that. So for equity sales, so when you sell shares to the public, just a general cash offer, meaning that you're just selling your shares and then you're receiving cash for them. A rights offer has to do with the concept of dilution. Say I have 100,000 shares, and so somebody that has 10,000 shares owns 10%. But if I sell a rights offer is when you're already public. But if I go and I sell another 100,000 shares, well, then whoever, say, had 10% before with their 10,000 shares now would only have 5%. That's called dilution. Just think of taking a bucket of water and putting more water in. There's just You dilute the current shareholders. So the concept is what's called a rights offer. We'll do the math later. I'm just talking about it right now in qualitative terms. The concept is what's called right of first refusal. Before you go and you sell shares to new people, if you need new capital for your company, what you do is you make what's called a rights offer to the current shareholders, and then they have the right to buy the new shares in the proportion that they had before so that they can keep their percentage of ownership that they had before you did that. So you'll see the math later. In terms of how do you do a cash offer, there's a few different ways. Firm commitment, and that has to do with you have what's called an investment bank. So, say I'm I'll take the example of where I work. Say I'm Sunbelt, and I want to sell $1 million or say 1 million shares on the market. I'm not going to be the one that's going to talk to every single person to sell it to 500 different people, 1,000 different people. There's an intermediate called an investment bank, and what the investment bank does is they do the whole process of bringing the shares to market. Now, there's two things that can happen. Either the investment bank ahead of time will say, it doesn't matter how many shares we'll sell at the IPO, we'll buy the whole thing, and whatever's left we'll put in our inventory, and we'll dribble it out later. That's called a firm commitment. The other one is called a best efforts, meaning that we're going to try, you want to sell 1 million shares, we're going to try to sell 1 million shares, but if we sell 900,000, we're just going to pay you for the 900,000, and we'll just return to you the inventory that we didn't sell. Dutch auction is a lot more rare. I think the last time that happened that I'm aware of had to do with Google. Instead of trying to sell everything, what you do is you ask everybody for what their price that they would like to pay, and then whatever you have, you basically allocate it to those people in descending order of what they bid. But that's extremely rare. You really don't, it's in the textbook, but in the real world, you rarely see that happening. The firm commitment and the best efforts are a lot more common. But I'm not a public company guy. I'm a private sector, private company. So I'm not sure which one, firm commitment or best efforts, is more common, but they're both used. Direct rights and standby rights is similar. It's the equivalent concept to rights offering of what the best effort and best efforts and firm commitment was. Shelf cash offer is something like after you go public, the company will say, we have another 100,000, 200,000, and then if the market demands it, then you'll just put more shares into the market after the IPO. Competitive firm cash offer. This is more like when you try to play different investment banks against each other. Direct placement. This is for private. It's a lot more common than you think. There's quite a bit of direct placements that happen. You just don't know about them because when you do a private deal, when you do a public deal like an IPO or a rights offer, any of those things, I mean the laws about disclosures are they're insane. There's just so much that you got to tell everybody everything at the same time. There's certain specific forms that you got to publish your stuff in. In private placements, there's a lot going on, but you just don't know. It's just done in lawyers' offices. Sometimes there's an announcement, a tiny little announcement in the newspaper, but there's billions and billions of private placement happening every year, and probably trillions in the U.S., and you just don't really know, especially if it's to private companies. Private companies don't have to to tell anybody that they, say, received $1 million or $2 million investment from somebody. Venture capital is a kind of direct placement. Private placement. So we talked about IPO. SEO, might not have heard that before. It just means seasoned equity offering. It's when you've already done an IPO, and then you go back to the public market, say for another round of financing. So it could be maybe you're an oil and gas company, and you've raised, say, 20 million in your IPO, and then you discover another field. So you need another 5 or 10 or 20 million. Then you would go back and sell more shares. But a seasoned equity offering is when you are already public and then you go and you sell more of your stock. What do underwriters do? Like I explained to you, underwriters, investment bank, same thing. Underwriting is one of the businesses that investment banks are in. Sometimes they're in other things like, what's it called? Proprietary trading. They might be doing, all kinds of other things. But underwriting, it's the process by which securities are brought to a public market. So examples of underwriters, you'd have, Morgan Stanley, Goldman Sachs are very famous ones. In Canada, you have smaller players. I'm sorry, I don't know their name. Most of them are in Toronto, obviously. Some of them are in Calgary. And what they do is they help you come up with, they're the ones that know the process to bring your shares into the public market. So they'll help you with the prospectus. They'll help you with, what price you should sell the shares at. So you don't want pricing an IPO is one of the most difficult yet important things to do, because if you price it too much, and like what happened with Facebook, and then Facebook, there's lots of other problems, but it looks really, really bad if somebody, say, buys a share at $20 when it goes public, and then a week later it's at like 12 or 15. So that's overpricing. Then the investors, your initial investors, feels like they got ripped off. The opposite is if you price too low, it's called leaving money on the table. Say if the market would have supported or kind of values a stock at around 15, and the investment bank says to their client, well, you should go public at 10 or 12. Well, if you say you're selling 1 million shares at the IPO, that's $3 million that the company's not going to get. So deciding on the price that you go public at is an extremely important, difficult, but challenging topic. Yeah.
So you don't choose the number of shares you do?
Yeah, you can. That's part of the whole, going to the market. They'll tell you, we think that the market will be able to. A lot of times, a lot of these investment banks have the connections with the pension funds, the very high net worth individuals. So they'll say, yeah, I know, this teacher's pension fund will probably take 1 million shares. They have the connections. That's really what you're paying, and they have a pretty good feeling of what is the amount of shares that the market will be able to absorb. So that's part of the advice that they provide the client.
If you issue a lot of really cheap shares, like $1 shares,
yeah,
and you want to raise 2 million maybe, then what is the difference between issuing 2 million shares at each $1, or I don't know, 100 shares at 200?
It's liquidity. If you have, on stock markets, shares trade by blocks of 100, they're called lots of 100 shares. So if you go public at $200 a share, that means that the minimum investment for somebody to invest in your company is $20,000. So there's not a lot of retail investors that are, say, managing their own personal portfolio that are going to go and put $20,000 on just a single company. That's why typically, like, a good price for a share is somewhere between 10 and 50. There's rules, for example, on exchange that if the share falls below $5 or $1, then like for example, on the not on the TSX Venture, but on the big TSX, I think if you're below $1 for more than 30 days or more than 90 days, you get delisted. So you got to pick the number of shares that you're going to sell so that the price is in a reasonable range. Typically, it's like 10, 20, around that. More than that, you got the issue of liquidity that people can't buy small numbers. So they can either buy 20,000 or 40,000 or 60,000. But if you have at $20, they can buy 20,000 or they can buy 21,000 and so on. So when investment managers are allocating the portfolio, it helps a lot more to have the price so that they can have just the right amount. Say they want to say, I want to put 3% of my portfolio in that company. If you have a price that's too high, it's very difficult to make the numbers work.
Even if the price, if the price is too low, then that creates more liquidity because you have more shares. Is the problem that they have to buy shares by lots, or?
If the price is too low, then, for example, in a lot of brokerage account, you pay a commission per number of shares that you buy. So if you're selling them, say at like 10 cents, or say if you're selling them at 2 cents, you would have to sell like 20 million. So somebody would end up paying a very large commission. And then if the price, there's many reasons. Like it's a lot more complicated. You're going to talk about this in third and fourth year. This is more of an intro course on how that works. You'll learn about it more later. Sell the securities. They're the one that manage how the IPO day goes. And then at the same time, price stabilization. So once the stock is public, the investment bank will keep some of the shares in their inventory. If the price is going up too fast, they'll sell into it. To remember that the price of something has to do with the balance of sellers and buyers. When you have more buyers than sellers in the market, the price goes up. When you have more sellers than buyers, the price goes down. So if you want to manipulate the price, not a great word, but say if the price is going down, then what they can do is buy shares in the market to, if you say go public at 10, then the underwriter might have that, if the stock starts to go below 9 or 8, they'll just start buying to support the price at that level. That's what is meant by price stabilization. Syndicate, that's not just a concept that's used in IPOs, but that's also a concept that's used, for example, in large banking loans. Say you're a large company like Canadian Tire, or say Petro-Canada, and you want to go for like a $50 million bank loan. Well, that's a lot of risk for a single bank to take. So what a syndicate is, it's a group of investors, or in that case, it would be a group of underwriters. And typically, that works quite a bit also with investment banks and underwriting, because say, Goldman Sachs might take, a quarter of the shares for sale, and, Morgan Stanley might take a quarter of the shares for sale, and then smaller investment bank might take 10% or whatever, and then they'll sell them to their own institutional and retail clients. The concept of a syndicate is that it shares the risk on a deal. If you have an investment bank that takes the responsibility of selling, say, a whole IPO of 50 million shares, and it doesn't go well, that's quite a bit of weight for one company to carry and a lot to lose. But if you spread the risk between 2, 3, 4 different investment banks, then that's a way for what's the word? It starts with a D. I forget. You have a portfolio and you have. I'll remember. I just have the word on the tip of my tongue. I can't remember it. But it's a way to distribute your risk. Diversified, that's what I was thinking. It's a way to diversify. Okay, spread is how, by the way, spread is how almost every financial intermediary makes their money. Either banks or in the either residential, consumer, or commercial loan market, or in the investment banking underwriting market. Spread in the banking market works this way. A bank takes deposits. They pay, say, 2% interest rate on their deposits, but then they loan the money out at 5%. That difference between the 5 and the 3, that's how a bank makes money. We're talking about a classic, savings and loan type of business. In the context of underwriters, the way that spread works, and you'll see, do I have an example there? There, I have an example. You have, so BB Drum is going public in an IPO. This is how the investment bank makes money. They will, if the price that you hear on the news, it went public at whatever, $25 a share in this case. That's what investors are paying. They're paying 25. But the investment bank, so the investment bank receives the 25, but they only give 22 per share to the company. That difference between the 25 and the 22 is called the underwriting spread, and that's how underwriters make their money. The difference between what they receive from the investor, the first person that buys the share, versus the money that they give for that share to the company that's going public. That difference is called the underwriting spread. Then you have another price, which is called the market price rose to 28 on the first day. That's called the initial return. So, the first person that bought it that morning would have paid 25, but then if somebody wanted to buy it at the end of that day, they would have paid 28. So, the way that the money gets split in this deal, BB receives 22 for each share that goes on the market. The underwriter gets 3. That's how they make their money. And the difference between 25 and 28 is somebody that would, what you would call day traders. They would have bought the IPO in the morning at 9:30, 9:31, 9:32 for 25, and then, towards the end of the day, they would have sold at 28. That's why the underwriter picking the right price is so important. If you pick the price that's too high and the price drops, there's nothing worse than an IPO that's down on their first day. Basically what that's saying is the people that bought the IPO, the people that the first purchaser of the shares, they got ripped off because by the end of the day, so you always want, but you don't want to have too little so that all the profit goes to the day traders that buy it at the beginning or maybe hold it for one day or a couple of days. So you want to have a balance between having a price where you're going to have a little bit of a pop on the first day, but not too large, and certainly not a drop. And at the same time, you want to have the price high enough so that the money goes to the investment bank or the underwriter and to the company instead of the people that, say on this deal, so it looks like the market values this stock at about 28. Because at the end of the first day, it's settled around 28. Well, if the underwriter says to BB, you should go public at 10. Well, instead of the company receiving $22 million, they're only going to receive $10 million. And all of a sudden, I received $10 million. I have $10 million in my bank account when I should have really had $22 million. That's not something that BB would be happy with. So that's why the advice on picking the right price, based on what investment banks know about who's going to buy, how much they're going to buy, is very, very important advice, very important knowledge to get. Yep.
Wouldn't the underwriters or the investment banks be kind of biased then? Because they're trying to create the biggest spread?
Yeah, but if they keep ripping off their clients, where do you think the next IPO, somebody that wants to do a next IPO, do you think they're going to go back to them? Yeah, it's kind of a, it's a market dynamic that, if company A, gets hosed by underwriter A, then when company B wants to go public, they're not going to go back to underwriter A. They're going to go to their competitors. So it's all about markets, supply and demand. You can, in finance, the sad thing is you can rip off people, but usually not twice. Because when you rip off somebody, somebody knows, tells other people, it's in the news, and then your business is over. So it's, some people are unethical, but it's not a long-term business plan. So the underwriting spread would be the offering price divided by the proceeds per share. Now remember that just in general, if you're trying to find a percentage of something, you just take, A divided by B. That will give you, 1 point something or 0.9 something, and then you do -1. That's the way that you get a percentage. So you'll see that kind of formula pattern show up, not only today, but earlier in this course and later in this course. So the offering price is the 25. The proceeds per share is what the company receives from their underwriter, which is the 22. And so the underwriter gets 13% return, or 13% spread. But they take the risk. You'll have a higher spread, going back to the firm commitment or the best effort. You'll pay a higher spread on the firm commitment because the investment bank is taking the risk that the shares will sell or not. You'll pay a lower spread on a best efforts deal because you're taking the risk. In general, in finance, whoever takes the risk makes more money out of the deal, but at the same time is risking more. So firm commitment, you might hear the expression a bought deal, meaning that before you go public, the underwriters essentially bought the whole pile of shares, and then they're going to resell them, and they take the risk of it being selling or not. Again, you have the underwriting spread, which is the way that underwriters make their money. And it does say most common type of underwriting in Canada, but then again, this textbook is 5, 10, 20 years old, so I'm not going to ask you in a quiz or a midterm or a final, is firm commitment or best efforts more common, because it might have been 10 years ago when the textbook was written, but it might not be today. I'm not up to date. I'm not a public market guy, so I don't really know. So let's share an example of, but you wouldn't need to know how does firm commitment work versus how does best effort work. Like I said, I wouldn't ask you to say, which one is more common in the marketplace, because that changes over time. What was last year might not be next year or the year after. So in a firm commitment, the idea being, okay, so when you look at a firm commitment or a best effort type of question, it's going to give you two numbers. It's going to tell you what the offering is and how much of it moved, how much of it was sold. So in this case, the total offering was $50,000, but the underwriters only sold $48,500. How much money does, what's the name of the company? I can't see it. It's just your company. So here's the key point. When you have a firm commitment, you will receive the money for 50,000 times what your proceeds per share is. When you have a best efforts, you will receive money for what sold. So in this case, because it's firm commitment, it's going to be 50,000 shares. $28 a share. and then it's like 1 minus 0.08. Sorry, so meaning that if the selling price is 28, that's not what the company receives. The company receives 8% less than that. So they'll receive 92% of 28. But they receive it for the full 50,000 because it's a firm commitment deal. On a best efforts deal, the company would have received the money for 48,500 shares at the, so this is the selling price, whereas this is the proceeds per share. In a best efforts deal, the company would have received 48,500 times the proceeds per share, and then they would have be given back the extra 1,500 that didn't sell. And it's up to the company to try to sell it later. So in this case, the company would get a check for 1.288 million. Best efforts is, as the term implies, the underwriter will try to sell all of it, but if they don't sell the whole thing, they return to you the extra. So here's an example now. Not everything sold. So Wexford was trying to sell 60,000 share, but only 48,250 actually sold. So the amount of money that they would receive would be 48,250. And so the offer price is 39, but the proceeds are 35. So they'll receive $35 a share. So in these types of questions, there's 4 numbers you're playing with. What was the original offer for? How many shares? How many actually sold? What is the selling price to the public? And what is the proceeds to the company? You got to make sure that you match the right number with the right number of shares with the right price to get the right answer. So in this case, the company would receive 1,688,750. So what are some of the costs of issuing securities? And those can be quite high. So that's why it doesn't make sense, even though you can when you're a small company, because some of these fees are fixed. Like a lawyer will charge you $50,000 to do the legal documents, whether you're selling 10,000 shares or 10 million shares. So there is a an economy of scale where, or you could say a diseconomy of smaller scale, where if you're not selling enough, if you end up raising, say, 500,000, but your legal fees, your accounting fees, the filing fees, and this and that are like 250, well, it wasn't really worth going public. But if, on the other hand, say your fees are 300,000, but you're raising 50 million, 70 million, then it's not such a big deal. That's why it's very difficult for a company that's very small to go public, because those fixed costs just completely hose you. You just, you might receive, $500,000, $1 million, but it's going to cost you, 10, 15, 20% of that in fees to get it. In terms of other things, indirect expense, a big one. Like I said, it's extremely time consuming for management. Once you're public, it's already quite, but just the process leading up to an IPO, there's a lot. And so maybe the CEO, the CFO, they're so busy, dealing with investment bankers and lawyers and, doing interviews on TV and talking to financial analysts, then, they didn't notice that, a competitor just came out. They didn't see it out of their peripheral vision and took like half of their business. So that's the risk with, going to this, is that management spends so much time, so much effort on this project, then they lose track of running, their original business. Abnormal returns, that's the whole price drop or price gain on the first. I've already explained that, if the underwriter prices it too low, it's what's called leaving money on the table. You could have raised a lot more, you could have had a lot more cash in your bank account at the end of the day instead of, some day trader or some hedge fund making the money off you. Over allotment option, this is quite common that, going back, say, to that example of say, like 50,000, you will probably have something in the underwriting contract and the prospectus that says that the underwriter has the option to sell another 5,000 if things go really, really well. Then again, that's a nice problem to have. Okay, so here's a nice point to take a break. All right, it's 7:58, so let's continue. So rights offering, that's really where, so far the math in the chapter was extremely easy. Pretty simple, just knowing, what number to use. The math for rights offering is a little bit more complicated, but really, So 15.8 is really where most of the meat, most of the difficult math stuff is in this chapter. So a rights offering, what's the concept? I was talking about it earlier. This is where you already have a publicly traded stock, and you want to raise more capital. Like I explained earlier, it would be unfair if you sold shares to new people, to new investors, and so the people that had the current shares would have their percentage of ownership of the company reduced, which is called dilution. So the idea is that you give the right, but that's important, not the obligation. So this is why it's called the right of first refusal. So instead of going to sell shares to other people, I offer it to my current shareholders first, and then if they say no, then I go and I sell it to other people. The mechanism by which this is done is for every share that you have, you're given a right, which is a separately traded piece of paper, or a security. And then, depending on what the proportion of new shares is to the proportion of old shares, you need a certain number of those rights in order to buy the new batch of shares. So it's harder to explain than it is to show you an example. Just in general, what is the value of the right? It gives you the right, the ability to buy this, what's called at the subscription price, which is typically a little bit less than the currently traded price, because otherwise nobody would be interested in buying the new shares. If I have shares already selling at 25, and I just sell new shares at 25, somebody's going to say, well, why go through this whole trouble? I can just, call my broker and buy it on the Toronto Stock Exchange. So what to motivate new investors to buy new shares, what you do is, say your stock is traded at 25, the subscription price might be 22 or 23 or 24. So, but each current shareholder gets one right for each share that they have, and then based on the number of new shares that they have, that tells you how many of those rights you need to cash in order to be able to buy some new shares at the subscription price. So let's look at an example. It's a lot easier to explain by example. So you have a company that the current stock price is 25. So that, yeah, that's where I was thinking of that 25. The company, this 10 million, they don't have it yet. This is some new money, some new capital that they're trying to raise. And so the current stock price is 25, but the subscription price is 20. So that 10 million of new capital, so how many new shares are going to be sold? Well, it's the 10 million divided, so F is the, it stands for funds, and P sub S stands for price for subscription. So if I want to raise 10 million and the subscription price is going to be $20, that means that I got to sell 500,000 new shares. How many rights will it take to purchase one of these new shares? Well, there's right now 5 million shares out there. So each one of those 5 million, well, they're not individual shareholders, but for each one of those 5 million shares, they will receive one right. And then what that means is, for those 5 million old shares that you had, you will receive one right, but there's 500,000 new shares that are being offered, meaning that you need to exchange 10 rights in order to get the ability to buy one share at $20. So that's what the second part is. The number N stands for the number of rights you need to buy one of these new shares at $20. S is how many old shares you have, and delta S is, remember, delta is the Greek symbol for change. So how many new shares? What is the change in shares that you're going to get? And what is the value of a right? Well, R0, R meaning, that's the remember that you have two different instruments here, two different financial instruments. You have the stock, and you also have the rights, which in itself is a financial security, because it has value, because it allows, having 10 rights allows you to buy something for $20 that's currently trading in the market at 25. That's how the company motivates new investors to enter, because they're offering the new shares at less than what the current market price is. So what is the value of that right? What is one right worth? It's the difference between the current price of the stock, P0, which in that case is 25, and what the subscription price is, which is 20. You always want, obviously, a subscription price that's less than the current market price, because otherwise, say the subscription price was 27. What's the point of me investing new money in the company at $27 a share when I can just go on the stock exchange, call my broker, and buy it for 25? So that's why you need the subscription price to be less than the current stock price for the rights offering deal to work. And so what is the value of one of those rights? 10 of those rights will give you the ability to buy one of the shares at 20. So when you have a right, which is each one of the 5 million old shares receive one right, what are those rights worth? They can trade actually separately from the original stock. So that's the difference between the market price and the subscription price divided by the number of rights it takes to buy one share plus one. So in that case, those rights are worth 45 cents. Each right is worth 45 cents. So an example of number of rights. So the number of new shares is going to be, what are the funds that you need to raise divided by PS. And so you want to raise 16 million. the subscription price is going to be $100. And so you're going to have to sell 160,000 new shares. And so how many rights do you need to buy one of these new shares? It's how many shares you had before divided by how many new shares you'll have. And obviously I would give you this formula and that formula in a quiz or midterm. So you have 800,000 old shares. And here's the key point to understand. People confuse between the right and the old share and the new share. For each one of the old shares, you receive one right. And you have 160,000 new shares. And so you need 5 rights. So old share cancels with that. You're left with right and new share as your units. Yep.
You have to write like all shares and new shares.
You don't have to, but it helps quite a bit to figure out what your. This is just, I'll give you full marks, or the TA will, if you. This is a third of the marks for this, a third of the marks for their putting the right numbers. But it really helps a lot to put the units. It helps to make sure that you got the right answer. Yeah.
The old share always worth one right, or do you just assume?
Yeah. No, that's the way that a rights offering works. For every original share there is, people receive one right. Then based on the proportion of new shares to the proportion of old shares, say if you had 100,000 old shares and you're selling 100,000 new shares, then you will need, you will need one right per new share. But it's always times one right. Yeah.
So if you had like 4 shares, you don't get this option.
Say again?
Say I had 4 shares.
Yeah.
I have 4 rights. I don't get this option.
Uh,
I need 5.
Well, typically you can only own shares in blocks of 100. But if you had less, you would just have 4 rights.
Yeah.
And then what you can do is the rights become separately traded. So for whatever price of the rights that you have, you could go sell your chance to buy at the subscription price. You could sell it to somebody else for them to go and buy at the subscription price. At least you get that. Or you could just let them expire and not use them. So the next one, well, that's really actually the numbers are the same as the previous problem. It's a continuation. And typically this is something that works, hint, hint, nudge, nudge. This is something that works great as a written question because this is something where you can have a nice progression of an ABC type of structure. So in this case, then, like you said, if you don't want to, or if you can't use those 4 rights that you have, if they were going to be traded to somebody else, what would these be? What would these be worth? So the value of the right today is the price of the stock today minus the subscription price divided by how many of your rights you need plus 1. So in this case, the current market price is 120. The subscription price is 100. you need 5 rights, which is what we had gotten from the previous example. And so each one of those rights is worth $3.33. So a little bit more on rights offering. Do I have a picture? Yeah. The concept of X rights is this. These rights are not something that lasts forever. They have an expiry date on them. So up to a certain date, the stocks, they expire. But who receives the right? There's the challenge there because, you know, every day, the people that own the shares in the public market, it changes. So when you say everybody that owns an old share receive a right, who are those people? They're the people that own the stock on the what is called the X rights date. If you own the stock the day before that, that's when the company looks at, you know, where to send the rights to, and then after that, then the rights are not on that share anymore. So, just more, they're generally cheaper than, because typically it's a pretty simple mechanism for people to remember that a rights offering is not a way to raise original capital, it's a way to raise a second round. But typically, you know, the firm commitment season offerings would be more common. So this is what happens. A company announces a rights offering on September 30th. Then on the X rights date, the people that own the shares before that are the people that receive the rights, and the people that own after, they don't. So on the X rights date, the value of the share goes down by exactly what the value of that one right is. So going back to the example before, well, this is just continuing the same example I've been doing. So the X rights price is the market price, minus what the value of the right is. The concept being that before the X rights date, the share is a bundle of a share and that one right. But after the X rights date, then the share does not include that right. So on the X rights date, the share should drop by exactly what the value of a right is. And so in this case, this is continuing the same series of example. The market price is 120, and the value of a right is 333. So the X rights price is 116.67. Yes.
And like all these little formulas, we'll have them on our quiz and everything.
I think the only one usually I might not give you is that one, because it's you kind of understand the concept that, like, I'll give you, I'll give you the delta S is F divided by PS. I'll give you N is S divided by delta S, and R0 is P0 minus PSN plus 1. But, you should understand the concept that the X rights price is just the share without the right on. So I'm probably not going to give you that formula right there, because it should be so obvious. Obviously 2 plus 2 is equal 4, right? I don't need to write like all the formulas on every quiz. Okay, the last concept in this series of example, well, there's one more, but what is the market value of the firm? So I'm still continuing that same rights deal that I've been using for my last couple of examples, where you have currently 800,000 shares out there. The market price is 120. The company is raising 16, and they're subscribing. The subscription price is $100 per share. So what will be the market value of the firm after the rights offering is complete? So the market value of the firm, V, that could be actually also E, because you're talking about there's no debt there. So that's going to be whatever shares you had plus the new shares times what the X rights price is. Because after the rights offering is complete, you will go from having S shares to having S plus delta S shares, and then the price will go from P0 down to PX. So you'll have more shares, but they will be worth slightly less because you have that effect of you need to sell them at 20 instead of 25, otherwise they won't move. So you had 800,000 shares plus 160, which is the new rights offering, and the X rights price is 116.67. And so after the deal is over, the total market value of the company will be 112,200,000. So the last math concept, looks like we'll be done a little bit earlier tonight. The last math concept in this chapter is the concept of dilution. So dilution happens in a couple of different ways. Percentage ownership. If I've given you a couple examples before. If you have a certain number of shares out there and somebody owns a certain percentage and then you sell new shares but that investor still owns the same number of shares as before, their overall percentage ownership of the company is going to be less. That's called dilution. And so the rights offering is one way to offer the chance to current investors to maintain. They'll have to put in new money, but it gives them the chance to maintain their current percentage ownership of the company. Another kind of dilution, well, that's what I would call stupid management, is if you're doing negative net present value projects, then the market value of your company is going to go down. Another one is the difference between book value and earnings per share. If be a good example. You sold, say, $1 million worth of shares, so you're carrying them on your balance sheet in the equity account as 1 million, but it's currently, say, traded at 900,000. So that's where the market to book. The market in that case would be the market value is 900,000, but the book value that you're carrying those shares on your balance sheet would be $1 million, so that's a form of equity. Really, the last two are really go hand in hand together. If you if you lose money, then your shares are going to be worth less than when you originally sold them. So here's an example. This is an example of percentage ownership dilution. So Big Burger Co. has 225,000 shares at a market price of 45. If the firm issues another 25,000 at 40, what will happen to the market price of the stock?
Oh, sorry, I should have raised the board there.
Okay, so dilution, what you need to do is you need to calculate the whole rights offering thing. So I start with so the number of rights is 9 to buy one new share. The value of a right so the market price is 45. The offering price is 40. And then you need 10 rights. So each right is worth 50 cents. So the X rights price is going to be 45.50. Sorry, 44.50. And so the change in percentage is going to be that, what is it worth afterwards? So that's what happens. You lose in percentage value in your shares if you don't exercise your rights and you don't sell them to somebody else. If you just let them expire, then you're going to lose. Yep.
Is it okay if in the quiz we do it with another method?
As long as you get to the right answer. But you still need to show, some formulas. What, you have a new way of doing this?
New way. I mean, can you go back to the
Yeah.
So if we multiply the 225,000 shares by $45 plus 25,000 multiplied by 40 divided by the total number of shares, so
You still get to the same place?
yeah, got like 44.5.
Yeah, well, it's two ways to get to the same place. No, but you would have to show some formulas, not just write 44.5, boom. It's one of these show your work kind of thing. If you show the formula and the numbers and things work out, you still get full marks.
There's no formula.
Okay?
There's no formula for this.
Well, you would still have to show, you can't just say this is the answer, because then you might have just looked at the person next to you and copied it. You got to show me how you got to that answer. Obviously, like you're saying, I take 225 plus, divide by, show how you get to that, and you still get full marks. Okay, so I have more examples, but it's already, we're what I'll do is I'll take a 5-10 minute break. What I do with more examples is it's just there's no new material. It's just if you want to see more of the same, so feel free to leave now. And I'm just gonna. This is kind of my slush fund of time. If I finish a little bit early, just take a break. Feel free to leave. All I'm gonna do is just more examples of what I've done today. All right, so let's continue. This is the more examples section. Normally what I do is for every lecture I have some of these, but I don't always have the time to reach them. This is just a way for me to adjust for how much time do I use for a certain class. If I finish a little bit earlier, then what I do is I just take a short break and then just do more examples of usually. Each example has a title or like a subject. So what I do is I look at some of the more tougher examples that are in the slides, and then I put them in the more example section. I tend to almost every chapter have more examples, and if the class I just finish up to the last regular slide by the regular time, you can still look up the more examples are still in the slides. And then when you look at the notes, they're the full worked out solution. So that's an extra way. Like I said, it's just kind of a slush fund of time for me, depending on whether I finish a little bit early or if I have less time, then I can just run the class up to the last regular slides, and then you can just look at more examples on your own later. So this is a number of shares in a rights offering. So the number of new shares is how much funds you're going to raise in the rights offering by the subscription price. So I want to raise $8 million. The subscription price is $2. Now people say, oh, should I really put this? I don't give marks for putting that extra stuff, but it's actually quite useful because it allows you to check, if I cancel that dollars with that dollars, I'm expecting an answer in shares, and then that's what I got. It's actually a nice way to make sure that you didn't flip numbers around. If you do something like this and then you end up that the units of your answer is what you're expecting, it's an extra kind of quality check, quality control to make sure that, say, you didn't flip. Because if you had written this fraction upside down, you would have gotten an answer in 1 divided by shares. Or if you had used the wrong kind of numbers, and I have, how many shares, but I end up with an answer in dollars, then I did something wrong in there. So it's not, I don't give marks, or I don't take marks off, or I don't give bonus marks, but it's a nice way to check your answers to make sure that your units balance. And when I do the examples in class, I try to always put the units there as much as I can. This technique is a lot more useful when we get into international finance, when you have different currencies, and am I multiplying by this, or am I dividing by that, or am I multiplying by 1 over that? And it's really easy when you do currency calculations to flip a fraction back and forth. And so if you end up with an answer in US dollar squared by Canadian dollar instead of US dollar Canadian dollar, it's a way to check to make sure that things balance right. So continuing the same series of example, actually no, that one is different than the previous one, because the previous one was, you were raising this, it's the same company name, but the numbers are different. Okay, so in this case, you're raising $5 million, and the offering price is $10 a share. So you will sell 500,000 new shares. And so the number of rights that you will need to buy one of those new shares is going to be how many shares you currently have, or the old shares, divided by how many new shares you're selling. And so you have 4 million old shares. You receive one right per old share. So old share cancels out with old share. And you divide by 500,000 new shares. So you end up with an answer in rights per new shares, which is what you're expecting. Well, I think this one, yeah, this one follows the previous one, because you're raising 5 million, and the subscription is 10, and the price is 12.50, and there's 4 million. Yeah, so that one follows the previous example. So in this case, the value of a right is the market price minus the subscription price divided by the number of rights to buy a new share plus 1. And so the market price is $12.50. The subscription price is 10. And N, which we found in the last question, was 8. And so the value of one of those rights is 28 cents. So what is worth 28 cents? It's the right to buy a share at the subscription price of 10 instead of buying it at, well, you need 8. You need 8 of those to get. So here's an example of an X rights price. This is an example of you got to do all the steps in a single one, because you need to get to the X rights price. So first you need to figure out how many new shares am I going to have. Then you need to figure out what N is, how many rights for a new share. Then you need to figure out what is the price of a right, and then finally what is the X rights price. So you're going to sell 1 million shares. I'm going to be a little short with the units because I have that much space. The number numbers. I do. Oh, sorry, I was looking at the wrong notes. I actually just did. Sorry, I must have confused you. I just did this example here. Yeah, how come nobody saw? Hey, the numbers have. Okay, so you have 2 million that you want to raise. Your subscription price. Oh, sorry, that's not Delta. That's PS. And so you're gonna raise. You need to sell 1 million new shares. Then, how many rights do you need to purchase one new share? It's 2. What is the value of one of those rights? It's $1.33. And what is the X rights price? So that's the price of the stock minus the value of the right. So that's $4.67. And then what is the firm worth after the rights offering? So before the rights offering, you will have S shares. After the rights offering, you will have S plus delta S shares. But then they'll be worth the X rights price. So you got 1 million plus 1 million. And the X rights price is 467.
Isn't that about 9 million?
Yeah, I think I have an error in the thing here. So 2 times, what is the, what's 2 times 4.67?
It's 9.34 million.
Gotta fix that. 9 point, what, sorry?
9.34.
9.34. Oh yeah, sorry, that's where I made a mistake here. Sorry, it's late for me too here. So it's 3 times. Now, is 3 times 4.67, what's that equal to?
Yeah, 14.
Okay. So the error wasn't in the answer, it's just what I wrote over here. Okay. Now there's one more, full X rights price. You can look at that in the notes. I want to show you one of the dilution ones as the last example for today. So Stephen owns 5,000 shares of A, B, and C. Right now, there's 1.2 million shares outstanding. The company is doing a rights offering for 300,000 new shares at a subscription price of 24. So the current stock price is 27. If Stephen sells his right and all the rights are exercised, meaning that all the new shares are sold, what will his ownership percentage be in A, B, and C after the rights are exercised? So it's going to be the number of shares that Stephen owns divided by how many shares there's going to be after the rights deal. So Stephen has 5,000 shares. And there's 1.2 million before. And there's another 300,000 as part of the rights offering. And so his ownership percentage will drop to 0.33, so 0.33%. Alright, so that's it for today. I will see you next week. No quiz next week, but the midterm the week after that.